Hey guys, my name is Rivu Ramprasad. I'm a mortgage agent and multifamily investor. After scaling my own portfolio, I wanted to help others do so. The purpose of this video is going to be digging deeper into CMHC multifamily financing and what makes it so special. We've all seen the ads on social media touting 5% down to buy an apartment building and so on and so forth. But for the sake of this video, we're going to simplify it into 3 key things as to why CMHC is better than conventional financing. 1. Much lower interest rates. 2. Much lower debt coverage ratio requirements. And 3. Longer amortizations. Bottom line is, you need less capital to buy the same asset. One thing people don't actually understand is you could fund many different types of properties under CMHC financing. Now, we all talk about multifamily, and the purpose of this video is to focus on multifamily, but you can also fund things like student housing, retirement homes, and other single-room occupancy buildings under this program. It is a really cool way to make your capital stretch really far to do some amazing projects. We can break CMHC financing down into 2 major buckets: conventional CMHC and MLI Select. And MLI Select's been the one that's on fire these days. But what is the difference? For multi-family financing specifically, so not discounting student housing and retirement homes, etc. For multi-family housing specifically, conventional CMHC is up to 85% loan to value. Now, based on the number of units and based on whether it's a purchase or refinance, your debt coverage ratio requirements changes. And there's no additional requirements like MLI Select to meet energy or affordability, etc. And it's pretty much just a matter of do you debt service or not at those terms. MLI Select, on the other hand, we could get a little bit more complicated here. So MLI Select has 3 main pillars that they're trying to achieve: energy efficiency, affordability, and accessibility. Within each one of these buckets, you can score points based on your performance. So for example, if you achieve 40% reduction in your energy efficiency of your building, you can get 50 points. Each one of these buckets has their own tiers, and the tiers are different based on whether you're buying an existing property or a new construction. So I won't go into all of those details now because frankly, that might change by the time this video comes out. A huge advantage of MLI Select is if you get 70 points or higher, you can start to unlock features such as 95% loan to value. But it comes with some catches. So for example, if you score points in the affordability criteria, you are locking into a 10-year affordability commitment regardless of the term, which means you can take a 5 or 10-year term but still have the same 10-year affordability commitment. On the flip side, if you're okay with an affordability commitment, you can actually score some extra points if you commit to a 20-year affordability commitment. It gets really tough to do that in Ontario, but there are some major players right now who are building massive projects with a key component being affordable housing. Now, whatever your view on social matters, I do think it is a cool proof that given the right financial incentives, people want to do the right thing. So how do you qualify for one of these loans? Now, this is a very high-level breakdown. It's going to be very file-specific, but I'll give you 3 key things that CMHC is going to be looking for. 1 is net worth. You need to have minimum 25% net worth of the loan you want to get. So let's say you're going for a $2 million loan. We need to be able to show a $500,000 net worth. Now, that can be liquid or it can be within properties. So if you own your primary res, that counts as well. The second thing that CMHC is looking for is at least 10% of the purchase price in liquid assets. So again, if you're buying a $2.5 million property, you would need to show at least $250K accessible. And the third thing is experience. CMHC is going to look to see if you have experience managing similar properties. But if you don't, that's okay too. You'll need to hire an experienced property manager who has experience managing similar types of buildings. I mean, at the end of the day, do you really want to buy a 10-unit property if you have no idea what you're doing? It's probably not going to be a fun time. Take it from me. Now that we've gone through a lot of, what it takes to qualify for CMHC, what CMHC is, and I mean, there's lots more details that we can share. I want to just focus on at least top 3 common pitfalls that I'm seeing on the ground with these CMHC applications. So the first one is not enough access to liquidity. The current economy that we're in is ever changing. With that comes interest rate volatility. Now, if you look back at the old video and earlier on, debt coverage ratio is an important part of the equation. So you could imagine if your interest rate goes up all of a sudden before you close and you haven't locked your rate in, now that's going to affect that whole equation because your mortgage payment skyrocketed. So people need to understand that while you can get up to 85 or up to 95% loan to value, there could be a chance you need to bring more money at the closing table if interest rates were to go the wrong way prior to you funding. The second thing is overestimated appraisals. I see a lot of investors moving from the residential market who have, connections with appraisers and all of these things, and they really push to get favorable appraisals. But it is imperative you work with an experienced appraiser who knows what they're doing, because CMHC will question it. I've seen countless files, not from me, where brokers have submitted files with inflated appraisals and then CMHC has challenged and knocked the loan down. You don't want to be in that position. It is very stressful. And that takes me to my last point. Big mistake people are making in this market is working with a broker who does not do these specific types of deals. Now, you need to understand that commercial financing, and especially CMHC, is a very niche type of mortgage brokering. This is not residential. There's a lot more to lose and a lot more to gain as well if you know how to do it right. Good brokers maintain good lender relationships, understand financing and capital structure, and at the end of the day, we are your professional capital advisors and we need to know what we're doing. So now that we've kind of covered the overview of what CMHC financing is, subscribe to the channel. I'll be using future videos to go through different case studies, files that are funded in the CMHC space, just so you could see the specifics of how these types of file works. We'll go through timelines, we'll go through costs, and so much more. And with that, I'll see you on the next video.